Hey, good morning, everyone. Marty Mazur here. It's Wednesday, the 27th of September, 2023, with your midweek market snapshot. Going to keep it pretty quick this morning. I'll start again with just a quick monologue on how I see the world as we sit here today with regard to the equity markets, which is generally our focus, or the majority of our focus on these updates, because that's what people are interested in. We continue to be very cautious in our outlook right here. Clients, which means we continue to have a short-term treasury money fund is our number one position in our core portfolio. And then we're hedging fairly close to the money right now, meaning we definitely have some oomph in our hedges if the market were to roll over in a big way anytime soon. So we want to kind of keep that posture while our assessment essentially says what it says right now. So you've got the market reacting to central banks, of course, the Federal Reserve being the key, certainly for U.S. equities. Over the weekend, voting member Neel Kashkari said he thinks that there's going to need to be one more rate hike, and then, of course, hold higher for longer to really get inflation under control. That's not something that the action or the current trading in the market, what seems to be moving equities, it's not something that would be welcome. And we've had another rough week so far. Right now, the market is trying to stay positive. At one point this morning, I think the S&P 500 was up about 30 basis points. It's just barely hugging the flat line right now. VIX volatility index was down a bit, and it's now rising as well. So could be a great day. I think we're probably due for a bounce. I'm going to look at the technicals for those of you who stick with me for the second half, and we'll talk about those prospects. But just a tough look, and it's been a tough technical look, as I've shown you here again on the charts. So with regard to the Fed and Neel Kashkari's comments and the overall feeling that they're going to stay higher for longer, we actually think within the course of the next few months, say now to 12 months out, the Fed is going to be forced to change course quite dramatically. We think that the economy is a lot weaker than some people feel, and certainly than the Fed is presenting, or that it's going to be in the relatively near future. Stock prices are valued as if earnings are going to continue to rise. Well, earnings are not going to continue to rise if the economy weakens like we think it's going to. We're going to get the GDP number for the third quarter tomorrow. It's going to be positive. And the more positive it is, probably the worse that'll look for the equity markets, particularly if on Friday, when personal consumption expenditures data comes out and you look at the deflator, which is the inflation metric that the Fed says they watch the most, if that's a little hotter than expected, stocks are going to have a rough end to the week. Any of that comes in soft, well, stocks are going to like it, because the soft view is that the Fed will soften or get easier in terms of monetary policy. The irony there is that what we think ultimately is going to happen in the near term will be positive for equities, meaning as it's clear that the economy is got some serious weakness coming. Initially, the way things are trading anyway, unless things begin to flip in a hurry, the market's going to like that on a very short-term basis until it realizes, or investors and traders in the aggregate realize that, this is more serious than we think, or than we want it to be, quite frankly, and earnings are going to come in, and therefore stocks are too expensive. So I'm not saying that's the outcome, and that means that stocks are going to get much more reasonably priced. At the end of the day, what I'm really meaning to say is that the risk of that is there to a great extent. Now, I'll finish up my monologue by paraphrasing this morning's research report from BCA Research's most bullish analyst. And I say most bullish on equity markets and on the economy. And even his and his team's view is beginning to comport more with ours. And again, I'll just paraphrase from the summary. The macroeconomic outlook, the U.S. economy is on a knife edge where weaker growth could tip it into recession, while stronger growth could trigger a second wave of inflation. They've gone from no recession to second half of next year. Now they're starting to talk about the first half of next year. So these leading indicators that we've been concerned about are beginning to show up in places that make even the likes of the most bullish analysts whose research we track, and who do a very good job, by the way, even has them thinking recession now. Now we have other analysts who I've talked about, who we pay for their premium research, who one in particular thinks that fourth quarter of this year is when the recession starts. They do a different kind of analysis. It's very robust and it's been pretty accurate. I'm not saying I agree or disagree with that assessment. I just agree that we're probably going to have a recession before this is all said and done. If it is in the fourth quarter of next year, well, then the rolling over of the market that we've seen recently is the real deal. We'll see. Time will tell with regard to that. But the first paragraph that I just read pretty much nails it, right? If we have a recession, stocks are going to have a problem. If we don't, inflation isn't going to go down to the Fed's target. The Fed's going to have to do what Neil Kashkari said, and ultimately the Fed will get credit for causing the recession that gets stocks to where they need to be. I'll say it one more time. As the data begin to roll over, you'll get a relief rally in stocks because it'll be viewed that the Fed's going to come into the rescue. Unless inflation just immediately drops down to 2%, which I don't think it's going to in that scenario, well, the Fed isn't going to be there to help initially anyway. And then, as I've shown you on 60 years worth of charts, then we roll into recession. The Fed can be cutting interest rates, and it doesn't matter. Stocks are going to have to reprice to reflect a dismal earnings backdrop. So you're kind of darned if you do, darned if you don't. If the economy rolls over, yeah, initially stocks are going to like it, but then they're going to roll over hard. If the economy doesn't roll over, the Fed's going to continue to talk tight and be tight. Stocks aren't going to like that in the short run until stocks roll over, and then you get the relief rally, and then the market goes down. So folks, let's just put it this way. And this is what I've been telling all of you clients, as you know, in the review meetings. This is a time to be very, very patient. Not get impatient, not get cute. Yes, clients, you've seen confirmations. We rolled out of 2 positions into a new one this week. We added a natural gas stock here a month or so ago. That's worked out well so far. I'm going to talk about here on the technicals what I talked about last time, and that was long-term bonds, the long-term treasury ETF we use in our core portfolio. We talked yesterday about ultimately, maybe sooner than later, rotating our small position in intermediate term treasuries into the longer term treasuries. There's going to be a lot of upside in long-term bonds if and when recession hits and interest rates roll over. So these are long duration, I used that term in yesterday's written blog, assets that will do very, very well and be a pretty good hedge against an equity portfolio that may be struggling in that environment. As I speak right now, looks like stocks are about to go negative. Tech stocks are holding up just barely. The S&P is about to go into negative territory, and the VIX is about to go positive. Now, we could end the day really, really strong. I think there's some dip buying to be had in here, but the fact that these little rallies are failing, at least for now, is not a good sign. More to come on that. So, folks, those of you who would prefer not to wade through the technicals, this would be your exit point. Thank you for listening. Hope you have a great rest of the day. For the rest of us, in front of you is the daily chart of the S&P 500. Remember, folks, we began to break down here. Broke below the 50, broke below the 20-day moving average, the 20-day dropping below the 50, all technically bearish stuff. Came through here with momentum. Gap down below the 43.25 right now. We're at 42.78. I think there's a lot of air between here and this line right here, 4,200. That looks like pretty strong support. That's the 200-day moving average and 4,200 on the S&P. So we'll see. We'll see if we get down there swiftly. I would absolutely expect a snapback rally off of this, but man, if we break through that, then we're getting to levels, or we're beginning to start looking at levels we think are consistent with the recession backdrop. The QQQ, the ETF that tracks the NASDAQ 100 index, remember we pointed out this little dip below this 2023 trend line right here. Next day tested it, lost it big time, gap down. Remember I said there's not much keeping it between here and 350. Right now we're at 355. 350 could be an area where some buyers come in. I would imagine there's more stop losses below that. You pound through there, stop losses get hit, and suddenly about 320 on QQQ looks like an area that if I were a short-term swing trader or just a short-term trader in general, I might want to load up for a day or three right there. But again, we think that ultimately the risk is that we go much lower. So right here, and remember that volume analysis we did last time, it's kind of an air pocket in there. So again though, right in here, you can see some support. Market's been trying to rally. In fact, it's trying to rally back. From what I said just a few minutes ago. Now the S&P is almost, it's about 20 basis points to the green, and QQQ is up about 27 basis points, where just like a minute or three ago we were going into the negatives. So, and the VIX has just dropped a full 1%. So definitely some buying coming in at these levels. Short-term stuff, folks. You're going to see a lot of back and forth, a lot of hedging and options dealers that are having to do their thing at certain levels as well. So look for a lot of volatility. Just an update you on the 10-year yield and then TLT like we did last time, and then I'll close. Remember I drew this rising wedge pattern in here, and then potentially bearish divergences if we were to roll over here, overbought on the RSI, still just dancing right at the top of that. Again, lots of people think we're going to break out. We think that we can, but in the short term, technically speaking, we could see a break to the downside. TLT, which basically is the kind of the reverse of that, although the longer term treasuries, 20 and 30-year treasury bonds in this ETF, basically you have the makings of bullish divergence there. You're oversold on the RSI. This is the one that the BCA just got bullish on. This is the one we own a little bit of, and we may own a little bit more of, as I suggested here a few minutes ago. It is up 30 basis points this morning as well. This is correlating pretty positively with stocks these days, because stocks are trading right now on the threat of higher interest rates. If stocks are going to really make that next leg lower in the bear market, which we think there's a high risk of, these things will correlate negatively in our scenario, meaning it'll be recession, it'll be interest rates coming down. This, in that scenario, would be barreling higher, while stocks in that scenario would be barreling lower. So ultimately, I think there's a hedging opportunity there. Clients along the edges, we will continue to add to positions that we think make good long-term sense, but this is not a time to take on a great deal of risk. We definitely have risk in the portfolio. We'll definitely feel some downdrafts, but we are hedging against something devastating and putting ourselves in a position to take advantage of something devastating should it occur. Thank you, as always, for watching and listening. Be back in 2 or 3 days with your economic update. Have something on the written blog for you tomorrow morning. Have a great day. Bye-bye.